Ever wondered what it takes to qualify for a mortgage loan? Well, you're not alone. The world of mortgage loans can seem like a maze, but fear not. We're here to guide you through it. A mortgage loan, in its simplest form, is a loan used by purchasers of real property to raise funds to buy real estate. It's a way for you to own a home now and pay for it over a period of time. The key to this magical door of homeownership lies in the qualification process, which is a systematic way lenders use to assess your ability to repay the loan. This process examines various aspects of your financial life, from your income and assets to your employment history and credit score. Understanding this process is crucial as it can greatly influence your journey to owning your dream home. Now that we have a basic understanding of what a mortgage loan is, let's dive into the intricacies of qualifying for one. The first step in qualifying for a mortgage loan is to understand the income requirements and the importance of assets documentation. Let's delve into income requirements first. Lenders typically need assurance that you have a stable and consistent income, enough to comfortably cover your mortgage payments. They'll look at your pay stubs, tax returns, and other income sources, such as rental income or dividends. Remember, the key is stability and consistency. Now, on to assets documentation. This is where you prove you have the financial capacity to handle a mortgage loan. Lenders want to see your bank statements, retirement accounts, and any other assets you might have. This not only demonstrates your ability to afford the mortgage, but also provides a cushion in case of unforeseen circumstances. It's like showing the lender you have a safety net, giving them confidence in your financial resilience. So, gather your documents, keep them updated, and be ready to present them when asked. With a clear understanding of your income and assets, you are ready for the next step. The next important factors in mortgage loan qualification are your employment history and the down payment. When it comes to employment history, lenders look for a track record of steady, reliable income. This usually translates to 2 years of consistent employment, preferably with the same employer. But don't worry if you've changed jobs within that period. What's important is that you've stayed in the same industry and haven't had significant gaps in employment. Lenders want to see that you're in a stable position to keep meeting your mortgage repayments. Now, let's talk about the down payment. This is the upfront amount you pay towards the purchase of your home, and it's a major factor in your mortgage loan qualification. The amount you'll need to put down will depend on the type of loan you're applying for. For a conventional loan, your down payment could be as low as 3%, but keep in mind, lower down payments often mean higher interest rates and mortgage insurance premiums. On the other hand, an FHA loan requires a minimum down payment of 3.5%. This type of loan is backed by the federal government, which makes it a popular choice among first-time homebuyers. But what happens if your down payment is less than 20% of the property value? Well, you may be required to pay for mortgage insurance in addition to your loan payment. This insurance protects the lender in case you default on your loan. While it adds to your monthly costs, it also allows you to buy a home with a smaller down payment. Remember, the down payment is not just about meeting the minimum requirements. It's about striking a balance between what you can afford to pay up front and what you can afford to pay each month. Next, we'll look at the role credit plays in qualification. Your credit history and score play a crucial role in the mortgage loan qualification process. Think of your credit history as your financial report card, documenting your past payment behaviors. Lenders look at this to gauge how likely you are to repay your mortgage loan. Your credit score, on the other hand, is a numerical representation of your credit worthiness. A higher score usually indicates a lower risk to the lender. For conventional loans, a credit score of around 700 is preferred, but it's possible to qualify with a score as low as 620. For Federal Housing Administration or FHA loans, the requirements are a bit more lenient. A minimum score of 580 can qualify you for a 3.5% down payment advantage. Even with a score as low as 500, you may still qualify for an FHA loan, albeit with a larger down payment. With a good credit score, you're one step closer to qualifying for your mortgage loan. The final steps in the mortgage loan qualification process are understanding your debt-to-income ratio and the FHA property requirements. Let's first dive into the concept of debt-to-income ratio, often abbreviated as DTI. This ratio is a measure that compares your monthly debt payments to your monthly gross income. Lenders use it to assess your ability to manage the payments you make each month and repay the money you have borrowed. Now, for both FHA and conventional loans, The rule of thumb is that your DTI should not exceed 43%. This means that no more than 43% of your income should be dedicated to servicing your debts, including your mortgage, credit cards, student loans, and any other outstanding debt you may have. However, it's important to remember that the lower your DTI, the better your chances of securing a mortgage loan. Now let's switch gears and talk about FHA property requirements. The Federal Housing Administration, FHA, has a set of standards that a property must meet in order to qualify for an FHA loan. These standards are in place to protect both the lender and the borrower. Firstly, the property must be primarily residential. This means that the property must be a 1 to 4 unit dwelling, and the borrower must live in one of the units as their primary residence. Secondly, the property has to be in good condition. It must have a stable foundation, a functional heating system, be free of hazards and toxins, and have adequate access to utilities such as water, electricity, and sewage. Lastly, an FHA-approved appraiser must evaluate the property's value and condition. This appraisal process ensures that the property is a good investment and that it complies with all the FHA's property standards. With these final steps, you now have a comprehensive understanding of the mortgage loan qualification process. Let's summarize the key points we've discussed about mortgage loan qualification. To secure your dream home, you need to understand and meet various requirements. First, income requirements and asset documentation are crucial. Lenders want to see your ability to repay the loan, and thus, your income and assets are under scrutiny. Your employment history is another factor as it provides lenders with insights on your job stability. The third thing to consider is the down payment. For a conventional loan, you might only need to put down as low as 3%, whereas for an FHA loan, the minimum required is 3.5%. Your credit history and score also play a significant role in the qualification process. Remember, both FHA and conventional loans have their own set of requirements. Furthermore, the debt-to-income ratio is important, as it shows your ability to manage your debts. Lastly, FHA loans come with specific property requirements and standards. And that's it. You're now equipped with the knowledge to navigate the mortgage loan qualification process. Thanks for watching.